Have you ever noticed that most investors don't technically lose money? They slowly give it away. Bad timing, emotional decisions, and chasing hype often turn the stock market into a donation box for impatient investors. In this video, I'm going to explain why most investors end up donating money to the market, the psychological mistakes that cause it, and how smart investors avoid falling into the same traps. Understanding this mindset shift can be the difference between long-term growth and constant frustration. Before we jump in, if you want clearer investing insights that help you keep more of your money instead of handing it over, hit the like button, subscribe, and turn on the bell so you don't miss future videos. You buy high because everyone else is. When a stock is going up and everyone's talking about it, it feels safe to buy. Your friend made money, your coworker made money, so you think you will too. But by the time you hear about it, the smart money has already been in for months. They're getting ready to sell to you. You're buying at the top because the crowd made you feel like you were missing out. That's not investing, that's following. And followers don't make money in the market. They fund the exits of people who got in early. The price feels justified because everyone agrees it's going up. But agreement doesn't equal value. You panic sell at the bottom. The flip side of buying high is selling low. And this is where most investors really donate their money. When the market drops and your portfolio turns red, fear takes over. You start imagining worst-case scenarios. What if it goes to zero? What if I lose everything? So you sell just to stop the pain. But here's what actually happens. You sell at a loss, the market recovers a few weeks or months later, and you watch from the sidelines as it climbs back up without you. You locked in your loss permanently. The investors who kept their money in the market got it back. You didn't. Selling during a crash feels like protecting yourself, but you're actually doing the opposite. You're turning a temporary dip into a permanent loss. Markets go down. That's normal. But they also go back up. If you sell every time you get scared, you'll never be in the market when it recovers. You chase the hottest trend without understanding it. Crypto, meme stocks, AI companies, whatever the trend is this year, you jump in because you don't want to miss out. But you don't actually understand what you're buying. You don't know how the company makes money, what the technology does, or what the risks are. You just know the price is going up. So you buy in, hoping to catch the wave. But trends don't last forever. When the momentum stops, the price collapses. And because you didn't understand what you bought, you don't know if it's a good time to hold or if you should cut your losses. So you freeze, you panic, or you hold on too long. Most trends are driven by hype, not fundamentals. When the hype fades, so does the price. If you're investing in something just because it's popular, you're gambling. You overtrade and kill your returns with fees. Some investors think they need to be constantly active, buying today, selling tomorrow, jumping from stock to stock. They treat the market like a video game, where more moves equal more points. But every time you trade, you pay. Brokerage fees, taxes on short-term gains, bid-ask spreads, all of it adds up. Even if some of your trades are winners, the fees eat into your profits. And the more you trade, the more likely you are to make emotional decisions. You buy something, it drops a little, you panic and sell. You see something else going up, you jump in late, then it drops. You're constantly reacting instead of planning. The best investors aren't the ones making the most trades. They're the ones who find good investments and hold them. Trading less means paying less in fees and making fewer emotional mistakes. You invest money you can't afford to lose. This is one of the biggest mistakes, and it makes every other mistake worse. If you invest money you need in 6 months for rent, bills, or an emergency, you're setting yourself up to lose. Because when the market dips, and it will, you won't be able to wait it out. You'll be forced to sell at a loss just to cover your expenses. Investing is only for money you won't need for years. If you're putting your emergency fund into stocks, You're gambling with your survival. And when you're investing money you can't afford to lose, every market movement feels like a crisis. You can't think clearly. You can't stay calm. You're just reacting out of fear, and that's when you make the worst decisions. Smart investors only put money in the market that they can leave there for 5, 10, or 20 years. You ignore diversification and bet everything on one thing. You found a stock you really believe in. Maybe it's a company you love, or a sector you think is going to explode. So you put all your money into it. If it goes up, you'll make a fortune. But if it goes down, you lose everything. That's not confidence, that's recklessness. Even the best companies can have bad years. Even the most promising sectors can underperform. If you concentrate all your money in one place, you're taking on massive risk with no safety net. One bad earnings report, one scandal, one unexpected event, and your portfolio is gone. Diversification isn't about playing it safe. It's about being smart. Spreading your money across different stocks, sectors, and asset types protects you from the unpredictable. You can still take big positions in things you believe in, but you balance them with other investments. You let your ego make your decisions. When you make a winning trade, it feels amazing. You feel smart, like you've figured out the market. So you start taking bigger risks, making faster decisions, ignoring warning signs because you're on a hot streak. Then you lose, and instead of accepting it, your ego kicks in. You tell yourself it was just bad luck. The market was wrong. You were right. So you double down, trying to prove you were right the first time. That's when small losses turn into massive ones. Your ego won't let you admit you made a mistake, so you keep making the same mistake over and over. Investing isn't about being right. It's about making money. Sometimes that means admitting you were wrong, cutting your losses, and moving on. The best investors have no problem saying I was wrong and out. They don't let pride cost them their portfolio. You think short-term wins equal long-term success. You made money on a trade last month, so you think you've got it figured out. But one good trade doesn't make you a great investor. The market rewards luck in the short term and discipline in the long term. You can get lucky and pick a stock that doubles in a week, but if you don't have a strategy, you'll give those gains back just as fast. Real wealth in the market isn't built on a few big wins. It's built on consistent, boring, disciplined investing over years and decades. Buying quality assets, holding them through ups and downs, and letting compound growth do the work. If you're chasing quick wins and celebrating every short-term gain, you're probably ignoring the bigger picture. And when the market turns, those quick wins disappear. When you step back and look at it, the market doesn't take money from investors. Investors give it up through fear, impatience, and poor discipline. The biggest enemy to your portfolio is rarely the market itself. I'm curious, what do you think causes investors to make the same mistakes over and over again? Share your thoughts in the comments. These discussions help everyone invest smarter. If this video helped you rethink how money is really lost in the market, don't forget to like, subscribe, and share it with someone who's trying to become a better investor. Thanks for watching, and I'll see you in the next one.